Joining us right now to talk about the market impact of what we heard is Saira Malik. She is Chief Investment Officer at Nuveen. And Saira, let's start with what we just heard from Rosengren. He was just talking about how data dependence doesn't mean you gyrate with every report. But of course, he's talking about the Fed. You're focused on the markets, and we will gyrate. What do you think the market should and will be doing after this?
Hi, Becky. Well, Santa visited the markets early this year for three reasons, and that's inflation, which is moderating, the Fed signaling a pause, and economic growth, which is cooling but not too cold. And today's job status supports that, but there is one wrinkle, and that's average hourly earnings at 0.4% is inflationary. And I think this is what is going to set up a complicated backdrop for the markets in 2024. We're rolling into the year expecting 5 rate cuts by the markets and the first one in March. And the pieces in place of inflation at or below target likely aren't going to be there by the time March rolls around. So some of this trade of the non-mega caps catching up to the rest of the market and S&P trying to cross 4,600, I think that gets difficult. And 2024 is volatile, likely to the downside at the early part of the year.
Is there anything that would change that perspective? I mean, we've also just heard that the economy may be weakening a little faster than the Fed might like. I guess the good news is that means rate cuts could come sooner. The bad news is that means the economy's in trouble.
I think there's two things to watch that could change the perspective either way, and that is the employment markets and the consumer. The consumer is what we're most worried about in 2024. We're seeing auto and credit card delinquencies increasing significantly, restaurant spending pulling back. I think it's the consumer that's really driven this economy due to the stimulus from the pandemic and the era of easy money. And if the consumer continues to pull back in 2024, I think that does pull the recession a little bit forward. But again, March is about almost 3-4 months away at this point. And I don't think we're going to see it that soon. And the market's going to have to price some of those rate cuts out.
Some people say this next year might be a decent year because it's an election year. You can bet that the government will keep spending. I guess that's up in the air at this point, depending on what happens with the Republican-controlled House.
Well, history's on your side in an election year. About 75% of the time, markets are up about 7.5%. But it is back-end loaded. It tends to start in the summer, which again sets up for that more volatile first half backdrop. The second issue going into this year, though, is market valuations, which are at a premium, given the 20-ish% run we'll have seen in the S&P for 2023. So you need to count on earnings for 2024. And it's going to be those companies that can preserve margins. The companies that we like are in sectors who can hold on to pricing power in a moderating inflation environment and manage through the economic volatility. We saw that with Broadcom today, which bucked the trend with stronger networking growth than people expected.
I think it's a little interesting what you're saying, though. You're concerned. We've heard so many people who are concerned about just the Magnificent Seven. You're a little concerned about the rest of the S&P 500 catching up. That raises brows for you?
Well, the reason the rest of the S&P 500 has been catching up in the past number of weeks is because yields have rolled over, because we're hoping for this aggressive 5 rate cuts. I think that's what's going to be priced out of the market somewhat in 2024. So that trade unwinds a bit. Next year, though, I don't think the Magnificent Seven is going to perform as well as it did versus the rest of the market like it did in 2023. But I'm not betting against U.S. tech. I mean, in an era of inflation continuing to moderate and rates at least at a pause and maybe some cuts later in the year, that's still positive for technology stocks.